All right, guys, let's take a look at the recent U.S.-India trade deal and what it could mean for global markets. Truthfully, it's hard to know what to believe. Some are suggesting that India might be aligning closely with the U.S., while others wonder if this signals tension within the BRICS alliance. One complication is that the announcement comes from former President Trump. He has a history of bold claims and narratives, so we need to be cautious and examine the situation carefully. Assuming the deal is genuine, on the surface it seems like a significant agreement. According to U.S. statements, India has agreed to reduce imports of Russian oil and start buying more energy from the U.S. Details from India are scarce, so most of what we know comes from the American readouts. Under the deal, the U.S. will lower the import tax on Indian goods from 25% to 18%, removing the additional tariffs tied to Russian oil purchases. So the baseline tariff for Indian exports would now be 18%. But what is India giving in return? According to U.S. statements, India would buy roughly $500 billion worth of U.S. energy, technology, agricultural products, and coal. India's total imports last year were around $800 to $900 billion, so this figure is substantial. It raises questions about how the deal would be implemented, whether over 3 years or a longer period. Additionally, Trump mentioned that India would invest $500 billion into the U.S. across multiple sectors, including transportation, energy, and agriculture. That makes it a complex, multi-layered agreement with several moving parts. If these numbers are accurate, India would be adjusting its energy sourcing significantly. In 2025, Russia was India's largest oil supplier, providing over 1.8 million barrels per day at discounted prices. Cheap Russian oil has been a major advantage for India, supporting lower energy costs and providing flexibility in exports and domestic manufacturing. Switching to U.S. and possibly Venezuelan oil may raise India's energy costs. It could also influence trade competitiveness with other nations, including China, which could benefit from any redirected Russian oil supply. There's also a diplomatic angle. India may be signaling stronger ties with the U.S., which could affect relations within the BRICS group. However, without official confirmation from India or Russia, it's unclear how much of the oil sourcing will actually change. If we look at the global picture, Russia's oil revenue has already been impacted by sanctions and discounted sales. Some of the market benefits appear to be flowing to China, which could see lower cost inputs for energy-intensive industries like chemicals and plastics. This could further strengthen China's trade position. Meanwhile, U.S. markets and the dollar are experiencing volatility. Events like rising interest rates, the AI sector bubble, and fiscal pressures are all influencing investor behavior. In this environment, gold and silver have been strong performers. Gold recently rebounded above $5,000 per ounce, and silver is approaching $90. The market has absorbed earlier selling pressure, and demand remains significant, especially from Asia. Asian demand, particularly in places like Singapore, has been exceptionally strong. If Western markets reduce buying, Asian investors often step in, supporting prices. Forecasts from some institutions suggest gold could continue to trend higher over time. Part of the initial sell-off in precious metals was linked to margin requirements in futures markets, which temporarily forced some positions to close. But buyers are returning, indicating ongoing interest in gold and silver as alternatives in a volatile global environment. Looking at central banks, Kevin Walsh's recent appointment at the Fed suggests a cautious approach. Interest rates and monetary policy decisions will continue to be closely watched as they influence both markets and currency strength. In China, the government is actively supporting the renminbi and encouraging capital inflows. The aim is to strengthen the currency and attract investment, including gold. China's money supply growth is outpacing the U.S., creating additional liquidity to invest in markets such as gold. Overall, the U.S.-India trade deal, global energy shifts, and monetary policies in major economies are creating a complex landscape. The story isn't simple. There are multiple winners and losers depending on how markets, energy supply, and trade flows evolve. So, what do you think? Did India really commit to such a large-scale deal with the U.S.? And what's next for gold and silver prices? Could we see further corrections, or is the trend still upward? Drop your thoughts in the comments below. Stay safe, and don't forget to smash that like button and subscribe as we continue navigating these interesting times.